Hello dear traders, my name is Elizaveta Belugina. I'm the head analyst at FPS, and this is our weekly Forex webinar. Today we will discuss the fundamental and technical factors for Forex measures currency pairs and give some trade ideas. Let's begin. And we start with our presentation. The agenda is quite the usual. First, markets positioning, then fundamental factors, then technical analysis, and finally summary and trade ideas. So as for the markets positioning, we as usually use data from CFTC, and I'd like to remind you that there is time lag in this data, and today is Wednesday, December 7th, and this data is for the week which ended with November 29th, Tuesday. But despite this time lag, it's still important to have a look at these figures. We still see that currency speculators, large players of Forex market, continued to increase their overall bullish US dollar position. And if we look at other currencies, we can see that the net short position on the euro is rather extreme, while gold has quite significant bullish position, which although was decreasing with quite strong pace. Also, we can see that Australian dollar longs have decreased. These are the most interesting, the most sizable changes in the market's positioning. The US dollar has stalled around 102 mark. If we are speaking about the US dollar index, which tracks dynamics of the American currency versus the currencies of America's main trading partners, there is a kind of consolidation, a kind of correction here after the temporary top formed around 102. And this technical chart of the US currency shows us that the weakening of the greenback may still not be over. We may still see lower levels of the American currency, but let's discuss fundamental factors for us to understand why the US dollar is moving in such a fashion, and then to compare it with other currencies. So fundamentally, the US dollar is still trading ahead of the Federal Reserve's December meeting. We have spoken about this meeting for several months, and finally it will take place next week. So finally we will find out how the Federal Reserve acts. However, at this point in time, the rate hike in December by the Federal Reserve is already completely priced in by the market. Let's have a look at this chart. You can see, I hope, clearly. This is the information from CME, and it shows us that the rate hike by the Fed is almost 95% priced in, that the Federal Reserve will increase its federal funds rate to from 50 to 75 basis points range. And this is a scenario everyone is pretty ready to see. Also, we saw that US non-farm payrolls data, which were released on Friday, were rather good. The figures, the gain in non-farm employment in November was significant. 178,000 new jobs was created in the United States in the non-farm industry, and it is pretty in line with the Federal Reserve's rate hike. So no divergence from this scenario is expected. The unemployment rate in America has declined, which is also good and also confirms this rate hike scenario. Although we saw a decrease in the pace of average earnings rate, still the general inflation expectations for America are high. They are linked with expectations that the newly elected President Donald Trump is going to conduct monetary stimulus and fiscal stimulus policy. Which will increase inflation in the United States. So despite weak average earnings, inflation is still expected to accelerate in the US, and this is another reason for the Federal Reserve to finally raise interest rate. So this is why this scenario looks like a given for us for December, the scenario of the Fed's rate hike, and everyone is ready to such turn of events by now. So it is not surprising, and by this time this factor is no longer moving the US dollar, is no longer helping the US dollar to appreciate. We also see that treasury yields have paused their advance. Here is the chart that shows it. This is the chart of US 10-year Treasury yields, the daily chart. And we can see here a kind of a top and a consolidation. The yields are in range. So all this leads us to believe that in the coming days ahead of the Federal Reserve's meeting next Wednesday, we will see the currency pairs which contain the US dollar more or less in consolidative mood, and the risks to the US currency are currently on the downside, despite the fact that the rate hike is certainly a positive factor for the US dollar as it is priced in already. We already saw the US dollar increase in November, and currently the market players are fixing their profit, taking their profit on this November increase of the US currency, and it is unlikely that they will initiate any new bullish position just on this run-up to the Federal Reserve's meeting. As for other currency pairs and other currencies, let's have a look at fundamental factors and then at technical picture. We start with euro. Here there was a pretty interesting news flow from the euro area. Firstly, this Sunday there was Italian referendum, and this time opinion polls have correctly predicted the outcome of the event, and they have found out that Italians have said no to the constitutional reform proposed by the now former Prime Minister Matteo Renzi. Renzi had to resign, and although there were many negative forecasts which were associated with such outcome of the referendum, still the market's reaction was more or less limited. We saw an initial spike in euro to the downside, but quickly the currency recovered, and all in all, now the situation is more or less calm, and in the short term we don't expect this factor to have a strong impact on the European currency. One of the reasons why the market has calmed down so fast, because the situation looks far from stable in Italy and political uncertainty is expected to be ahead for this country. One of the reasons why traders don't seem very concerned with this event is the expectations that the European Central Bank will announce the extension of its quantitative easing program on Thursday, tomorrow. The European Central Bank will have its final meeting of 2016, and the majority of analysts and experts believe that Mario Draghi will announce the extension of quantitative easing QE program by about 6 months. All in all, the monetary policy of the European Central Bank represents an interesting but rather complicated question. To understand it better, I must tell you that the ECB is conducting an extremely easy monetary policy. Its balance sheet is now bigger than that of the Federal Reserve. Despite this fact, inflation in the euro area is still below the central bank's target. Inflation has accelerated in November, but it's still far from the 2% target. The European Central Bank has to make inflation reach the target level. It has to help the European economy produce good figures of economic growth. So it is buying assets in the form of this quantitative easing program. The interest rates in the region are already very low at the minimum and even negative level. So the central bank has to use these non-standard monetary policy tools to somehow help the economy and encourage inflation. But at this point in time, the quantitative easing and extension of the program is almost completely priced in by the market. And this is why we don't see any strong moves in the euro dollar to the downside. And on the contrary, analysts are discussing the problem that the ECB should signal that its asset purchases, its quantitative easing, should eventually end. It is that there is no infinite number of the assets the ECB can purchase, and everyone realizes that an end and an eventual tapering of the QE program should come. And this tapering, the expectations of tapering are keeping the euro in demand and don't let the single currency significantly fall and make the pair of euro dollar fall below support levels. So the market players will be watching the meeting and the press conference of the European Central Bank on Thursday. This is surely the main driver for the single currency for the next several days ahead of the Federal Reserve's meeting. In my opinion, it is likely that we will get some positive impact on the euro after this meeting, because I agree with those who think that the European Central Bank should slowly but surely start to decrease the amount of its asset purchases. All in all, Mario Draghi, the head of the European Central Bank, sounded rather positive in his recent speeches, and he even made hints that the amount of asset purchases should decline even if the European Central Bank extends QE program beyond March 2017. So this scenario is more or less positive for the single currency. Let us now look at the chart for the euro dollar, and let us, start with a weekly chart, and we may see that the euro dollar currency pair has met support in the area of 105.30 close to 105. This is the multi-year support line which goes back at least to the minimums of 2015, and 105 is a big psychologically important level for the euro dollar. We saw that after some hesitation, there was a doji candle formed on the euro dollar weekly chart. The currency started to recover. The bulls have won this battle. The fact that the bears failed to push the pair lower, the fact that there is a strong support line here made the pair rebound from this line. So we are currently recovering the losses in euro dollar. It is happening slowly but surely. About 24% of the market's decline since May of 2016. And the next levels to watch here are 108 and 108.40. These are resistance levels to watch. On the 4-hour chart, we can see that the 50 period moving average is moving above 100 period moving average. This is a positive sign, and a sign that after some consolidation, probably above 106.85, this is a former resistance and now support, and the next support is around 106.40. The euro dollar may test 108, 108.40 and 109 marks. These are our targets on the upside. So I think the picture for the euro should be more or less clear by now. All in all, the technical picture, the chart picture reminds us of the inverted head and shoulders figure, although this pattern doesn't seem to be very regular. Still, as long as euro is trading above 106.50 and even 105.70, the picture for the currency looks rather positive, and we can hope for more recoveries of the single currency. Now let's move to our next currency, the next fundamental factors we should discuss. Next, we come to the British pound. Recent data were rather negative. Today, we got the news that British manufacturing production fell by 0.9%. All in all, the recent data from the UK were not as bad as analysts would have expected after the Brexit vote in June. But still, today's figures gave the market a negative impression, and we will see later that this data affected the pound and made it decline versus the US dollar. Another piece of news, another important driver for the sterling in the recent days, and this driver will continue to have an impact on the British currency in the next trading sessions, is the talk about Brexit and, to be more precise, the legal procedures which should be set in motion before for the Brexit to actually begin. As we know, the UK High Court in November announced that British Parliament should and actually may have a vote on the Brexit process, on the timeline of triggering Article 50, which should be triggered to begin Brexit. Earlier, it was thought that British government would be doing all the work and would be initiating Brexit. And Theresa May, the UK Prime Minister, said that she is going to trigger Article 50 by the end of March 2017. Then there was the decision of British High Court in November, and this decision created expectations that Brexit would be delayed by several years, or even this scenario will be entirely cancelled. This helped the British pound recover. But today, Prime Minister Theresa May has announced that she will ask Parliament to back the government plan to formally serve Article 50 by the end of March 2017. Currently, the UK Supreme Court is starting an appeal to make the Parliament decide the fate of Britain in the European Union. But today's announcement by Theresa May sounded negative for the British pound and made traders believe that after all it would be the government which will trigger Brexit, and it would make it in time according to the schedule in March 2017. So these recent developments we saw this week were negative for the British currency. Also watch the discussion which concerns Britain's access to the European Union single market, as this news flow is also important for the pound. And earlier there were comments that Britain may actually pay for access to the European Union single market. But the nation's Foreign Minister Boris Johnson has downplayed this idea. So once again, some concerns about the British pound. We don't consider these fundamental factors extremely bad for the pound at this point. More or less, the pound remains to be undervalued after its big decline which followed Brexit. We can see that still GBPUSD has retraced only 23.6% of Fibonacci of this post-Brexit decline. But still, there is scope for some downside in GBPUSD currency pair. We are now looking to the level of 1.2430 from the current levels of 1.26. Here at 1.2430, one can find support line of the recent uptrend in the British pound. And also here we find the 50-period moving average on the daily chart, so 50-day moving average. On the upside, GBPUSD met resistance of this Fibonacci retracement area, and also here is the 100-day moving average, which is located just below 1.28 mark. Here it is. $1.28. If we look at the Japanese candles, we can see that although British pound was able to continue pushing to the upside after its initial unsuccessful attempt to break above 1.2660, let us put this level in the chart. This is even 1.2670 to be more precise. This is November 11th high, and there was firstly an unsuccessful attempt to get above this level on December 1st, when despite this long upper shadow of last Thursday's candle, GBPUSD pushed up, but there was no momentum. Momentum has slowed down, and there was limited by 1.2750 on the upside before we saw GBPUSD return below 1.2670 mark. We see on the daily chart the stochastic indicator is giving us a bearish signal. So short positions with targets around 1.2450, 1.2430 look like the best trading strategy for GBPUSD. As for the US dollar, there are no big news events ahead of the Federal Reserve's meeting. But here in GBPUSD, I believe that news from Britain, some renewed concerns about Britain may be the main driver of the pair in the coming sessions. Let us move further to Canadian dollar. I'd like to speak more about Canadian dollar as we have the Bank of Canada's meeting, which will take place today, and its results will be announced at 15 GMT. No policy changes are expected from the central bank. However, traders will still be waiting for the central bank statement to know how it is evaluating the nation's economy. If we look at Canadian economic fundamentals, we will see that they are mixed, but mostly positive. We have seen better GDP figures from Canada. We have seen rather good consumption. Trade deficit narrowed according to the latest data, and some slowdown in manufacturing, some deterioration in business sentiment is at this point not so important. There are significant risks for Canadian economy associated with the expected policy of America's newly elected President Donald Trump. However, it is unlikely that the Bank of Canada will take these risks into account now, as Donald Trump will officially become the US president only in January, by the end of the month, and still some time is going to pass before he introduces some changes to US-Canadian trade relations. So this is more of a long-term risk, and we don't think that the Bank of Canada will pay much attention to it at this day's meeting. So the near-term picture for Canadian dollar should be mostly positive. In addition, we see that oil prices remain supported, remain high. We know that Canadian economy is a big exporter of oil, and this is why Canadian dollar is sensitive to changes in oil price. So higher oil prices after the meeting of the Organization of Petroleum Exporting Countries, which took place last week, represent a bullish factor for Canadian dollar. We expect that oil prices will remain more or less supported. They will be above $45 per barrel for the Brent oil and probably closer to $50. And this is good for Canadian currency. So oil is a supporting factor. Let's have a look at the chart of USD Canadian dollar. Here we can see that after some attempt of the US dollar to appreciate, which took place in the first part of November, USD Canadian dollar failed to overcome 50% Fibonacci level, which is located at 1.3575. Now, actually, the pair went below even 1.33 mark. This level is now a resistance. And in line with our bullish scenario for Canadian dollar after the Bank of Canada's meeting, we can foresee the decline of the US dollar Canadian dollar currency pair with the first target at 1.3190. Here we find 100-day moving average, and it should provide some support for the pair. On the 4-hour chart, we can see that there is a negative intersection of the moving averages. The 50 period moving average went below 200 period moving average, and we also are about to get negative intersection from 100 period moving average with 200 period moving average. These moving averages create resistance for the pair around 1.3415. This is resistance. And if we see the attempt of the pair to recover to this area, here probably once again sellers will begin to pull the pair to the downside. If the Bank of Canada's meeting outcome is bullish for Canadian dollar, then we won't see this setback to the upside in the pair, and it will just move to the target at 1.3190 from the current levels of 1.3278. This is what we can say about Canadian dollar. Let's move to the next currency. It's Australian dollar. The Reserve Bank of Australia left its benchmark rate unchanged this week at 1.5%. And all in all, we can say that the statement of the regulator was rather positive. However, Australian GDP fell by 0.5% in the third quarter, and this release turned out to be quite surprising for the economists because the decline of Australian economy on the quarterly basis is a rather rare occasion. We have seen this only 4 times. It is the 4th time in 25 years. So this was kind of a negative surprise for Australian dollar bulls. The main reasons of the decline are weak construction output and public spending. So these are the weak areas. However, the majority of the economists think that we won't see technical recession in Australia because GDP will recover in the 4th quarter. However, some analysts still think that the Reserve Bank of Australia will have to cut rates in 2017. So opinions diverge, and no one is really sure how the RBA will have to perform in future, despite the hopes which prevail. Still, there are some cautious thoughts, and there are still risks which are associated with Australian economy. At the same time, the positive factor for Australian currency is the fact that Australian yields are still high, and during the times when the market sentiment is positive, these yields provide an opportunity for investors to gain, which make Australian assets and Australian dollar attractive for investors. So this is a supporting factor for Australian currency. Let's see how all this is reflected in the price chart of Australian dollar, US dollar. And this is what we see here. Actually, the volatility of the currency this week wasn't that high. If you look at the 4-hour chart, we can see that we are moving in range of the previous week. There is a rather strong resistance at 0.75 mark. It is limiting the upside in the pair for already third time. We can see here, or maybe fourth. And support is not that constant here, it's more dynamic. More or less, the pair didn't go below 0.73 mark in the recent month. So this is the main support on the downside. We can draw a support line through the recent minimums, and here it is. And this will draw our attention to the round level of 0.74, which is currently the main support for Australian dollar US dollar. So this week the pair is in sideways range in 100 pip range between 0.75 and 0.74, and we will see which level will give way first. I believe that in the coming days we won't see significant drivers for Australian dollar, and the pair still has some scope to remain within this range during this week, during Thursday and Friday. Much will depend on the US data. We see that the US dollar itself is currently weaker, which limited the decline in this currency pair after we got surprising contraction of Australian GDP. And all in all, this narrowing triangle shows us that the bears are not as strong as the bulls. The bulls and the bears are fighting, but the bears are able to make the pair return to 0.75 mark for several times, while the pair formed a higher low last week, which shows that the bears weren't able to push the pair as low as the week before. So returning to the daily chart, we see that there is strong resistance ahead, but the daily moving averages are in a more or less horizontal state right now. So for now, our trade is to trade the range between 0.75 and 0.74, or stay out of the market if you are not a good range trader, and look for the break below 0.74 to put the take profit to the 0.7330 mark, or to wait for an attempt to break higher and then targets levels around 0.7590. This should be the trade for Australian dollar. But I'd like to repeat that this week I don't see events which may help Australian dollar to leave this range, and in my opinion it should be still rather difficult for Australian dollar to break this upside resistance. So we need to be cautious here. And one more currency pair which we still haven't talked about is the US dollar Japanese yen pair. Let's have a look at it. Dollar yen showed us fifth week of growth in a row. This week is not over yet, so maybe something will change. We can see that the pair was rising, but the bullish momentum has slowed down, as the pair met resistance at 100-week moving average, which is currently located at 114.70. The next resistance is located at 100p 15.40. This is 61.8% retracement of the decline from May to June. And it seems that the US dollar has already played its bullish card. It has already made most of its advance. The US Treasury yields have paused the advance as well, as we remember from the slide in presentation. And this creates the risk that the US dollar Japanese yen currency pair won't be able to overcome this resistance line. All in all, the major factors which are moving the pair come from the United States. Japanese data don't move on the pair for now. Traders are not actively speculating about the policy of the Bank of Japan. So it's all about the US and the US dollar. If we look at the daily chart, we can see that the technical indicators, the oscillators, are currently at the extreme levels, and of course some correction looks necessary at this point. For now, corrections in dollar yen have been rather shallow. All in all, here the longer term outlook remains positive, but the bullish momentum has declined. The indicator shows us that the advance of the pair has been too rapid and that some new drivers are needed here. Some new forces should be in place in order to overcome this technical tiredness of the pair and to make it conquer new highs. And let's have a look at the 4-hour chart. Here we can see that this week the pair failed to overcome the high of last week, which took place at 114.82. And as long as we are trading below this level, we can't risk by taking new bullish positions. And even if you want to trade dollar yen buying this currency pair, I suggest you to be cautious and to trade only above 114.80 and to put small take profit, limiting your position on the upside by the level of 115.50. This is the Fibonacci level I've mentioned. On the downside, the pair is supported by the moving averages. 50 moving average is at 113.40. And we can notice that the slope to the upside of these moving averages has evened and the line is now horizontal. Let's have a look at the 20-day moving average. In order to see how the fastest moving average is reacting. And we can see this violet line, the pair is just at this moving average, and the decline below will make it test 113.40 and the next support around 112. If this level is breached, then 110, 109, 20 levels will get inside. So we see also at the 4-hour chart the divergence between the price chart and the technical indicators MACD indicator is giving us the greatest visual of the fact that the current highs of the price are not confirmed by the highs of the indicator, and that momentum, the bullish momentum of this currency pair has declined. So this is it. This is what I have prepared for today. And let us now review what we have said, sum everything up, and make some conclusions. So the market is awaiting the Federal Reserve's meeting minutes, which will take Federal Reserve's meeting, which will take place next week on December 14th. And by now, the Federal Reserve's rate hike in December is completely priced in. So traders expect no surprises from the central bank, and the US dollar can no longer be driven by these rate hike expectations. As a result, we saw a decline in the US currency, in the US dollar index, and consolidation in many currency pairs. The US dollar is giving back its territory. Maybe we can see different dynamics in different currency pairs, but on average, the US dollar has given back some of its gains and its advance has paused, and they expect the things to stay like that in the coming days ahead of the Federal Reserve's December meeting. As for the euro dollar, it has managed to gain and quickly recover after the Italian referendum and its negative outcome. The pair is trading above 107, and the main driver, the main risk event, is the meeting of the European Central Bank on Thursday. Analysts expect the central bank to extend its monetary stimulus package, but this is already priced in, and as euro dollar has reached important support at 105 mark, we don't expect this level to be breached to the downside. On the other hand, if the European Central Bank gives a signal that it is tapering its quantitative easing program despite the extension, the euro may still show some gains and try to test resistance at 108 and 108.50. British pound has been affected by some negative developments in British economy and political sphere, and we think that the currency is vulnerable to decline to the levels around 1.2450. Resistance is located at 1.28 mark. US dollar Japanese yen has slowed down its advance. We will look at resistance at 114.80, and even if the pair managed to overcome this level, take profits should be rather conservative and put around 115.50 mark. Support is located at 113.40 and 112. For the Australian dollar, it is in tight range between 0.75 and 0.74, and the lack of drivers may keep the pair in this range during the next trading days. We also await the meeting of the Bank of Canada, and the risks are to the positive side for the Canadian currency. So as long as Canadian dollar is staying below resistance at 1.34 mark, 34, at 1.33, I'm sorry, as long as US dollar, Canadian dollar is staying below 1.33, there is a good chance that the pair will decline to 1.3190 level. This is our main target on the downside for this currency pair. So this is all for today. I hope that my presentation was useful to you. And see you next week. We will discuss the latest development of the Forex market. And once again, have new trade ideas. Thank you for your attention. It was Elizaveta Belugina from FBS. Good luck and have a good trading day, trading week, and trading month. Thank you for your attention. Goodbye.